All right, so we are continuing with current liabilities here. Sometimes you might have a situation where liability is incurred in one year and then is satisfied in the following year. And so, in that kind of situation, while the interest has been accruing continuously, you do need to accrue it for the purposes of financial statements. You need to actually accrue it at the end of the year. You have to do a periodic adjustment to that. Some companies might do it monthly or quarterly. In this case, we're just going to do it annually. Again, you have to, even though that interest is accruing, remember, you are incurring an expense over a period of time. And so if I'm going to create financial statements for a portion of that time, I need to figure out how much interest I need to accrue for that period. We're going to kind of make it easy and really focus on interest-bearing notes, but you'd have to go through a similar process if it was a zero interest bearing note as well. So here's an example. They borrowed $12,000 from Panther Bank on November 1st, 2025. The note bears 9% interest, with repayment on April 30th. So provide the issuance, the fiscal year end, and the repayment of the note. Now, in this case, we are going to use interest payable because the interest bears contractual interest. So if you remember before, when we didn't have a contractual rate, we would use that discount and we would amortize the discount. And in this case, though, we're going to kind of make the assumption that the market rate of interest is the rate of interest on the note. But just to be clear, even if it was zero interest bearing or if the market rate and the contractual rate were different, we would still need to accrue, but it would accrue using the discount or potentially even a premium. In our example here, again, we're kind of walking through the issuance, which is hopefully not too bad. The cash that we received is $12,000, and now, of course, we have that note payable for $12,000 as well. And then again, right away, interest starts accruing on the note until eventually on December 31st, we come to a fiscal year end, and now we need to prepare our financial statements. And so we've got to accrue that interest on our financial statements. And so again, we use that same formula, which is the face amount of the debt times the annual percentage rate times the proportion of the year. In this case, November, December, that's 2 out of 12 months. Therefore, the amount of accrued interest is $180. And again, really the right way to think about it is now I owe $180 of interest. Again, I'm not paying it, but I owe $180 of interest. Therefore, I've incurred $180 interest expense. And then we have the repayment on April 30th. Let's get the easy ones first. First of all, we're going to remove that note payable and we're going to remove the prior interest that we had accrued. Both of those are credit balances. So we're going to remove those with a debit. And then the next thing we need to do is we need to record any new interest expense. Again, remember, it's a continuous process. And so we had January, February, March, and April. So we had 4 more months of interest. And so again, we take that face amount times the 9% times 4/12, which means we have an additional amount of interest expense that we incurred of $360. And then finally, what we're doing is we're figuring out, okay, what is the total payment? Of course, we have to pay back the note and we have to pay back the total accrued interest on the note. Again, it's contractual interest. And so over the life of the note, there were 6 months total, which of course is the sum of these two numbers for a total of $540. And so that is how we would accrue against that note and then record the payment on that note. Again, I'm guessing you've seen some of this stuff before, so I don't feel like it's new. But we're just gonna, the next section though, I think is new, which is paid vacation and other absences. One thing we have to sort of figure out first of all is when do we accrue or when do we record paid vacation? And just to be clear, what we mean by paid vacation or other compensated absences, it means that someone doesn't work, but we pay them as if they did work. And so in most cases, you earn that paid off time off, PTO, through other work, right? So I work today, and then in part, I start earning days off in the future. And so as you're earning those days off, we're going to accrue that, but only under certain circumstances. So first of all, that future obligation, it does have to be based on work that's already done. In other words, I as an employee earn vacation days, and there's nothing else I need to do in order to earn those days. The second one is that the paid absence can be taken in a later year. In other words, there's a vestment to this interest where to this benefit where I can accumulate it. It's not use or lose. I don't have to take it immediately. And then if you fire me, you have to pay me for that time. And so that's that second criteria. The third criteria is payment is probable, meaning that it's likely that the person is going to take vacation or take those days off. And then finally, the amount of what I'm going to have to pay them for that time off has to be reasonably estimable. So again, just sort of thinking about most paid vacation and things like that are included in this because it meets those four criteria. I just want to be clear that there are criteria that must be met in order to accrue this as an expense in the current period. So we're going to walk through an example. There's other ones in the book, sabbaticals, sick days, things like that. But we're going to kind of go through a pretty straightforward example. All right, so company has 150 employees. Each employee earns 4 hours of paid vacation for every 40 hours worked. Vacation time is not taken in a period earned. Then it can be carried over. Each employee makes $25 an hour. And again, I'm sort of setting this up to show that it meets those four criteria. And then we see actually sort of what actually happened in week four versus or week ones, two, three, and four. Pause. Sorry to close my window there, or close my door. Anyway, so you can see, what they actually worked and then time taken off. I made this one a little bit simple in that no one took time off without being compensated. And so if you kind of total these across, they all total 6,000 total hours. So either they worked the hours or they were paid for vacation days. Kind of made it a simple example. So it's a multiple step process in order to figure out what these journal entries should be. So the first thing we got to do is in each week, we need to figure out how many vacation hours did they actually earn. And so in week one, again, that ratio is you earn 4 for every 40. And so they earned 600 hours in the first week. They earned 596 hours in the second week. 588 hours in the third week, and 576 hours in the fourth week. Again, hopefully that math is fairly easy to follow. It comes right from the chart up here. That's step one. Step two then is we need to figure out the net vacation hours earned because in some of the weeks they're taking vacation, and so you earn and you use some all in the same period. And so in week one they earned 600, they didn't use any, so that's pretty easy. In the second week they earned that 596, but 40 were used for a net of 556. In the third week the net was 468, and in the fourth week the net was 336. Now it's possible that at some point in time, employees could use more hours than what they've earned. I mean, in a typical situation, if you think about it, I might work for, I don't know, 20, 25 weeks and then take a week off. Well, in the week that I took off, of course, I'm not working, so I'm not earning anything and I'm only using. And so understand that kind of builds, but it could drop in any given period. And then over time, it tends to kind of steady out. You kind of earn as you use and then earn and use, earn and use. But again, just sort of getting to that net hours earned. And that net hours earned number becomes the important number that we're going to use to increase that liability. Again, we're trying to figure out, remember, there's a compensated absence. I'm going to have to pay employees in the future, even when they're not working. And so the increase to the liability is the journal entry. And so in week one, the net increase in vacation time was 600 hours at $25 per hour. That's a $15,000 liability. In the second week, it's 13,900. In the third week, it's 11,700. And in the fourth week, it's 8,400. And so what do we do with this information? Again, the key idea here is now you've done some work. I now have a liability to pay you in the future for the work that you've already done. And so what we have then is a liability, a compensated absence liability. I have a future obligation. There's going to be a sacrifice because I'm going to pay you, and it's for work you've already done. So the transaction has already taken place. And then on a second thing that you're going to have with one of these journal entries is, of course, I do need to actually either pay you for the work or the vacation time that you've taken. So there's going to be a credit to cash, or there could be a situation where I might accrue it on a Friday and pay it on a Monday or something like that. And if that were to happen, then you'd have a temporary salaries payable. But if you record it and pay it on the same day, then it's going to be a credit to cash. And so, really, there's two things then that are driving this transaction. One is how much cash am I actually paying them, or how much cash do I currently owe them? And then the second thing is how much vacation time did they earn, and what's the cost of that? And so those two payables are driving this transaction. So those are the two credits that we're focused on. And so again, thinking about week one, they earned $15,000 in vacation time, and then we paid them $150,000 for the work that they had done. And so those two things together, and this is really theoretically sound, is that we're creating these liabilities, and those liabilities are actually driving the expense. And so you can see that the salaries expense is not just what we pay the employee, it's also the vacation time that they earn. Again, that liability, those liabilities accumulate to the salaries expense. And similarly, in the second week, slightly different numbers. I'm still paying them $150,000 in total again, because there's been in the mixture between work and vacation, there's a total of 6,000 hours. But then, of course, the compensated absence increased, but by a lesser amount, and therefore the salaries expense is still more than what we paid, but a little bit less than what it was in week one. And then week three, it gets a little bit smaller, and week four, it gets a little smaller again. And then again, over time, you could potentially have it go the other way, but just in general, this is kind of how it would work. Again, so you have the increase or decrease to the liability, that's going to be a debit or a credit. The amount that I pay is going to be a credit, and then the salaries expense is derived from the changes in those two accounts. And so we're deriving the salaries expense. We're not calculating it directly. All right, so we got a little bit of time. I'm going to go through a few other examples here. Another example is when we have an advance. Fortnite company, they lease large. They're the leasing company. They lease large pieces of equipment to its customers. They not only get the lease, which we're going to cover that completely separately, but they do require $1,000 deposit on each piece of equipment to cover damage beyond normal wear and tear. Deposits are returned to the customers once the equipment passes an inspection at the end of the lease. And let's just say we record deposits on 100 pieces of equipment and their subsequent return, and we're going to assume that 25% of the deposits are forfeited because the damage was beyond normal wear and tear. So how do we record this initial deposit? Again, key here though is while I receive $100,000 cash, I do have an obligation to return that cash. Now that cash return is contingent upon an inspection, but there is an unavoidable obligation out there. And so I really don't have any revenue or any expense here. Now I received cash, but at the time I also have a liability. They offset each other. And since there's no net change, in that case, there is no revenue. But again, if I get to keep some of the cash, then it will become revenue. I just have to wait until the situation plays out. And so if we kind of fast forward a little bit, when we talk about that return or the time of the return, the deposit comes off of our books because the obligation for me to return the money has now expired. And in this case, I only had to return $75,000 out of the $100,000. And so the cash credit is only $75,000. And then the difference is revenue that I earned from that deposit. And so notice I had to delay recording the revenue from the deposit until the obligation was satisfied. And so once I satisfy the obligation, now I can record that deposit revenue. All right, we're going to stop there and we will pick up the next one when I get to the next recording.